If your income disappeared tonight, how long could your family survive before bills, debts, or everyday expenses crushed them? It's a question almost no one wants to think about. Yet, it's the exact moment life insurance steps in quietly, powerfully, and often misunderstood. Most Americans have no idea how life insurance actually works, why some policies cost almost nothing while others feel impossibly expensive, or how a simple decision today can secure a family's entire financial future tomorrow. And because of that confusion, millions either buy the wrong policy, get talked into something they don't need, or avoid life insurance altogether until it's too late. In this video, you're going to learn the clearest, most complete breakdown of life insurance in the United States. Exactly what it is, how it works behind the scenes, the difference between term whole and universal life, how cash value grows, how payouts are decided, why premiums vary so widely, the biggest mistakes people make, and most importantly, how to choose the right policy for your own life. No jargon, no sales pitch, just the truth in simple language anyone can understand. By the end, you'll know more about life insurance than 90% of people, and you'll be able to protect your family with confidence, clarity, and peace of mind. Let's break it all down from the very beginning. Life insurance, at its core, is a simple promise disguised inside a complicated industry. It's a financial agreement that says, when you die, the people you love won't suffer financially because of it. Everything else, the paperwork, the agents, the policy names, those are just details layered around a very human purpose. Life insurance exists to replace income that can no longer be earned, to eliminate the debts a family would otherwise inherit, and to create stability at a time when emotions are already overwhelming. In the United States, where medical costs, housing expenses, and education fees have climbed higher than ever, losing the primary breadwinner can devastate a household in weeks, not years. That's why life insurance matters, not for you, but for the people who depend on you. To understand how life insurance works, think of it as a financial shield. You pay a small amount every month or year called a premium, and in exchange, the insurance company guarantees a much larger payment to your beneficiaries if you pass away. That larger payment is known as the death benefit. It could be $100,000, $250,000, $500,000, or even millions of dollars, depending on your coverage needs. What makes life insurance unique is the leverage. A small, predictable cost today can secure a huge amount of protection tomorrow. And yes, insurance companies are not charities. They're businesses that operate on statistics, probabilities, and carefully calculated risks. But for individuals and families, life insurance is often the only tool that can instantly create wealth at exactly the moment it is needed most. Whether someone wants to cover funeral expenses, clear a mortgage, protect their children's future, or simply give their loved ones breathing room to grieve without financial panic, life insurance is how Americans build that safety net. By the end of this video, you will all see that life insurance isn't complicated. It's just been explained poorly for decades. Once you understand the basics, everything else becomes clear. To understand why life insurance costs what it does, you need to understand the business behind the scenes. Life insurance companies operate on one central idea: risk pooling. Imagine millions of people paying premiums into one giant pot. Some people will unfortunately pass away early, triggering large payouts. Others will live long lives and never trigger a claim. The company's job is to balance these probabilities so the pot always has enough money to pay out claims while still generating profit. This is where actuaries come in, the mathematical masterminds of the insurance world. Actuaries analyze massive amounts of data: age, gender, health history, lifestyle choices, occupation risks, and even zip codes. Using mortality tables, charts that predict how long people statistically live, they calculate how much a policy should cost. If you're 25 and healthy, the risk of dying soon is extremely low, so the premiums can be surprisingly cheap. But if you're 55 with health issues, the risk increases dramatically, and so does the price. Insurance companies also invest the premiums they collect. While you're paying them monthly, they aren't letting that money sit still. They invest in bonds, real estate, and long-term financial instruments. This investment income helps them keep premiums lower for customers while still making enough profit to operate. Another crucial detail: not everyone keeps their policy forever. Millions of people cancel early, switch policies, or let their coverage lapse. When that happens, the insurance company keeps every dollar ever paid without ever paying a death benefit. This is one of the reasons companies can afford to pay out large sums to the small percentage of people who pass away during their coverage period. Understanding the business model also helps you understand why companies ask so many questions, why they want medical exams, lifestyle details, and smoking history. They're not being nosy. They're calculating risk to price your policy as accurately as possible. And once you understand this, the entire industry begins to make sense. Term life insurance is the simplest and most affordable form of protection, and the most recommended for the average American family. A term policy covers you for a specific period, usually 10, 20, or 30 years. If you pass away during that period, your beneficiaries receive the full death benefit. If you outlive the term, the policy expires, and there's no payout. That's it. No cash value, no investment component, no complicated financial structure. The reason term life is so inexpensive is because the risk is low. Most people who buy 20 or 30-year policies will live beyond that period. That means the insurance company collects premiums, but often never pays out. For you, that's perfect, because you're only paying for pure protection, nothing extra. A healthy 30-year-old can easily get $500,000 of coverage for the price of a few streaming subscriptions each month. Even $1 million in coverage is often shockingly affordable compared to other forms of insurance. But term life has downsides too. Once the term ends, the policy simply disappears unless you renew it, and renewing it at an older age becomes exponentially more expensive. The other downside is that term life does not build cash value. Once you've paid premiums for 20 or 30 years and survived the term, you walk away with nothing. Some people don't like that, but it is important to remember. You pay for car insurance every year and never complain about getting nothing back if you don't crash. Term life works the same way, except the benefit is far bigger. The real purpose of term insurance is to protect the years when your income matters most, when you have a young family, a mortgage, debts, or financial responsibilities that would crush your loved ones if your income disappeared. Once your children are adults, your debts are paid, and retirement savings are strong. Many people no longer need life insurance at all. That's why term is the perfect fit for most households. Simple, affordable, and highly effective. Whole life insurance is completely different from term. Instead of covering you for a set period, it covers you for your entire lifetime as long as premiums are paid. That means no matter when you die, your beneficiaries receive a payout. But what truly sets whole life apart is the cash value component. A portion of your premium goes into a savings-like account inside the policy. This account grows over time, tax-deferred, and you can borrow against it, withdraw from it, or use it to pay premiums later in life. This is where the appeal begins and where the confusion starts. Because whole life includes savings, insurance companies charge significantly higher premiums. You're not just paying for coverage. You're also building an asset. The cash value grows slowly in the early years, then accelerates later as the policy matures. Some policies even guarantee a certain rate of growth, which attracts people who want stability instead of market volatility. Whole life is often described as forced savings, and for some people, that's exactly what they need. It provides a steady, predictable way to grow money while ensuring permanent coverage. It's also used for estate planning, intergenerational wealth transfer, and tax-advantaged financial strategies. Wealthy families often use whole life as a tool to protect assets and minimize estate taxes. But whole life has downsides that people should understand before buying. The biggest is cost. Whole life premiums can be 10 to 20 times higher than term for the same death benefit. That means a family could spend thousands annually without fully understanding the long-term financial commitment. And while cash value growth is stable, it's rarely impressive. During the early years, your cash value might grow painfully slowly, leading some buyers to feel misled. Whole life is not good or bad. It's simply a tool, and tools only work when used correctly. For some people, like high earners or those with complex financial goals, it can be incredibly valuable. For others, especially families living on tight budgets, term insurance is usually the more sensible choice. Universal life insurance is often marketed as the best of both worlds: flexible premiums, lifelong coverage, and cash value potential. But in reality, it's a complex product that requires careful understanding. Unlike whole life, where premiums and growth are fixed, universal life offers adjustable payments. You can pay more in certain years, less in others, or even skip payments if your cash value is large enough. That flexibility is attractive, but it also introduces risk. There are three major types: Guaranteed Universal Life, GUL, Indexed Universal Life, IUL, and Variable Universal Life, VUL. GUL is the simplest. It acts much like term insurance, but lasts for life. It has minimal cash value, but it's cheaper than whole life while still offering permanent coverage. It's ideal for people who want a lifetime policy without the cost of whole life. IUL, the most heavily marketed type, ties your cash value growth to market indexes like the S&P 500. The key word is ties. You're not actually invested in the market. Your cash value grows within a range, usually with a cap and a floor. For example, if the market grows 20%, you might only get 10%. But if the market crashes, you might still get 0% growth instead of losing money. This can be beneficial, but the caps, fees, and internal charges are often misunderstood or hidden in the fine print. If the market underperforms for several years or fees increase, your policy could require higher premiums to stay alive. VUL is the riskiest. Your cash value is invested directly into the market, similar to mutual funds. This means higher growth potential, but also the possibility of losing value. It's suitable only for people comfortable with investment volatility. The biggest issue with universal life is that many agents oversell it by promising unrealistic returns, tax-free retirement, or free income. These claims can be misleading. Universal life is not a scam, but it's a tool that demands ongoing monitoring and proper funding. When used responsibly, it can be powerful. When misunderstood, it can become a financial burden. Have you ever wondered why one person pays $20 a month while another pays $200 for the same amount of coverage? That difference comes down to risk, and life insurance companies are masters at calculating it. Premiums are not random. They're built on data, statistics, and actuarial science. The first factor is age. The younger you are, the longer you're expected to live. That means insurance companies can collect more years of premiums before a claim is expected. A 25-year-old might get a $500,000 term policy for $25 a month. The same policy for a 55-year-old could cost 10 times as much. Next is health. Insurance companies look at your medical history, family history, blood pressure, cholesterol levels, BMI, and more. They may ask for a full medical exam or use no exam simplified underwriting, which costs more because the company takes on more risk. Conditions like diabetes, sleep apnea, high cholesterol, or past surgeries can increase premiums significantly. Lifestyle matters too. If you smoke, even occasionally, you'll face higher premiums. If you skydive, scuba dive, ride motorcycles, or work a dangerous job, your rates will reflect that. Even your driving record can affect pricing. Too many violations signal risky behavior. Then comes policy structure, the amount of coverage, the term length, and whether the policy includes riders or cash value. A $1 million policy doesn't cost double a $500,000 policy, and is often cheaper per dollar of coverage because of risk efficiencies. Finally, companies evaluate your financial profile. Insurance companies don't want people to overinsure themselves. If someone earning $30,000 a year applies for a $5 million policy, that raises red flags. Insurers check whether the coverage amount makes sense for your income and financial responsibilities. Understanding how premiums are calculated helps you make better decisions, avoid overpaying, and choose the right type of policy for your unique situation. The moment a loved one passes away, emotions overwhelm everything. Bills, paperwork, and financial worries are the last things anyone wants to think about. This is where the death benefit of life insurance payout steps in with clarity, speed, and simplicity. But understanding how it works can help ensure your family never runs into surprises. When a policyholder dies, their beneficiaries must file a claim with the insurance company. This usually requires a copy of the death certificate and simple claim forms. Once submitted, most companies process and pay out the benefit within 1 to 4 weeks. It's not like other financial products. Life insurance payouts are typically fast, seamless, and designed to reduce stress during a difficult time. One of the most important elements is that the death benefit is usually tax-free. Your beneficiaries receive the full amount, whether it is $50,000 or $5 million, without owing federal income tax. That's one reason life insurance is considered one of the most powerful financial tools available. But there are situations where claims can be denied, and understanding them now prevents problems later. The biggest risk period is the contestability period, the first 2 years of the policy. If the policyholder dies during those 2 years, the insurer reviews the application to make sure no information was left out or misrepresented. If someone lied about smoking, hid a serious medical condition, or provided false information, the company can deny the claim. Another issue is unpaid premiums. If a policy lapses because of missed payments, there's no payout, even if it was active for decades before. That's why it's critical to keep policies updated. Despite rare denials, the life insurance payout is one of the most reliable financial promises available. When everything is set up properly, it ensures your family receives the protection you intended, exactly when they need it most. Life insurance riders are optional features that let you customize your policy based on your needs. Think of them like upgrades, some valuable, some unnecessary, and some intentionally marketed to inflate the cost of your policy. Understanding the major riders helps you choose wisely and avoid overspending. One of the most important riders is the accelerated death benefit. If you're diagnosed with a terminal illness, this rider allows you to access a portion of your death benefit while still alive. Most policies include this for free because it's so essential. It helps pay for medical bills, caregiving, or simply giving you time to focus on what matters in your final months. Another popular option is the child rider, which provides a small amount of coverage for your children. It's inexpensive and ensures your kids are protected until they become adults and can buy their own policies. The waiver of premium rider is extremely useful for younger workers. If you become disabled and can't work, the insurance company pays your premiums for you, keeping your policy active even when your income stops. This rider is especially valuable for permanent policies like whole life. The return of premium rider is often misunderstood. It is available mostly on term policies and promises to refund every dollar you pay in premiums if you outlive the term. While attractive, it costs significantly more and isn't always financially efficient. Some riders, like accidental death benefits or guaranteed insurability options, can be useful in specific cases, but are not necessary for most people. Insurance agents often push riders because they increase the policy cost and their commission, but many families don't need more than basic coverage. The key is to choose riders that add real protection without complicating your policy or inflating your premiums unnecessarily. Despite good intentions, millions of people make costly mistakes when buying life insurance. The most common error is buying too little coverage. Many people choose $50,000 or $100,000 because it feels affordable, but it's nowhere near enough to replace income, pay off debts, or protect a family long term. Another major mistake is waiting too long. Every year you delay, your premiums increase. A 30-year-old might get $500,000 of coverage for $20, $30 a month. At 45, the same policy might cost 3 times more. At 55, it might become unaffordable. Another costly mistake is buying whole life when term is the better fit. Whole life can be a powerful tool, but agents often push it aggressively because commissions are higher. Families on a budget sometimes get locked into expensive whole life policies they can't maintain. Then the policy lapses, and all the money paid is lost. A simple, affordable term policy would have provided much more protection for far less money. People also make the mistake of trusting one quote. Insurance prices vary widely between companies. A person denied by one company may qualify for excellent rates at another. That's why comparing quotes is essential. Another major mistake, relying only on employer-provided insurance. Job-based life insurance is temporary. If you quit, get laid off, or change jobs, your coverage often disappears. Many families are left unprotected without realizing it. Finally, people fail to update beneficiaries or review their policies. Life changes, marriage, children, divorce, new financial responsibilities, but many never update their coverage or beneficiaries. This leads to confusion, disputes, and even accidental payouts to the wrong people. Avoiding these mistakes is simple once you know them, and it can save your family from financial disaster. Choosing the right life insurance policy doesn't have to be confusing. Start by asking one simple question. If I died tomorrow, what financial burden would fall on my family? List your mortgage, debts, income replacement needs, childcare costs, and future plans like college or retirement for your spouse. This gives you a clear estimate of how much coverage you genuinely need, usually 10 to 15 times your annual income. Once you know the amount, decide how long your family needs that protection. If you have young children, a 20 or 30-year term is usually ideal. If you're older or want coverage for life, consider whole life or guaranteed universal life. Next, consider your budget. A policy only works if you can keep it long-term. For most people, term life offers the best balance of affordability and protection. Whole life is best for people with higher incomes or specific financial goals, while universal life offers flexibility for people comfortable managing a more complex policy. When speaking with agents, ask direct questions. What's the total cost over the lifetime of this policy? What happens if I miss a payment? Is this policy guaranteed, or can premiums change? What's the surrender value in the early years? Agents should be transparent. If they hesitate or push a product aggressively, that's a red flag. Always compare quotes from multiple companies. Each insurer evaluates risk differently, so one might offer significantly better rates than another. Also look for strong financial ratings through companies like AM Best, Moody's, or Standard & Poor's. Finally, keep your policy organized, updated, and known to your family. A policy is useless if no one can find it. Choosing the right policy is not just a financial decision. It's an act of protection, love, and responsibility. After everything we've covered, one thing becomes crystal clear. Life insurance isn't really about policies, paperwork, or premiums. It's about people. It's about the family you love, the future you're building, and the quiet promise that even if something unexpected happens, they will never face it alone. Understanding how life insurance works puts you ahead of most people who buy it without ever knowing what they're repaying for. Now you know the difference between term and whole life, how companies calculate premiums, how payouts work, and how to choose the right protection for your life. Whether you're a parent, a spouse, or simply someone who wants to leave behind stability instead of struggle, taking action today is one of the strongest financial choices you can make. So take a moment, reflect on what your family would truly need, and make sure they're protected. If you found value in this video, make sure to like, subscribe, and drop a comment with any questions you want answered next. And if you want to go deeper, check out the videos linked on screen about choosing between term and whole life, and how much coverage you actually need. Thank you for watching, stay informed, and take care of the people who matter most.